And even still, it's like you can't know everything. You can't expect to know everything. You need to surround yourself with people who can supplement your weaknesses and help make a strategy and plan because, whether people are aware of it or not, our biggest expense every single day, our biggest expense, hands down, is taxes.
Welcome to the Dynamis Podcast, where we are all about unlocking a fruitful life, removing your limiting beliefs, and getting to the next level. My name is Tim Gurule, and I'm stoked to grow on this journey with you. As David Geffen says, we are each the figment of our own imagination, and some people have the greater ability to imagine than others.
Deni, welcome to this week's episode of the Dynamis Podcast. I'm really excited to have you here because, we just got out of tax season, and tax season is generally a nightmare for most entrepreneurs, most investors. The reason it's a nightmare is because we typically don't have adequate strategy. We don't have adequate help. We don't have adequate planning. And I feel like, me personally, I filed an extension this year, literally still tallying up all my bookkeeping. It's just a nightmare. And when I call and I'm looking for advice of, how should I do this next deal? What entity should I do it out of? Like, how do I maximize my deductions and keep the government, keep their grubby hands off of my income from overpaying taxes? I just feel like I never get the answers I want. I'm always outgrowing my tax professional. And so I know that we've been talking a lot about taxes recently. We've had another tax representative from Provision on the podcast, but I don't think we can talk about it too much. And I'm really glad to have you here because you have a ton of incredible insight and experience in the market. So I'm stoked to have you here, Deni.
Thanks for having me. I'm excited to be here.
Can you just give us a quick background of what were you doing when you first got started? What did you transition to? And how did you end up doing specifically what you're doing right now? I know you have a niche. You specifically like working with small business owners. You focus on real estate. How did you get here? And then what were kind of some of your takeaways from working at these bigger firms that you are now implementing to, give the clients that you have today the best outcome possible?
So I actually began my career in high school. I worked at a small CPA firm in a very small town. And so I knew what I wanted to do from a very young age. And I was working with families, businesses, very small businesses back then. And I kind of helped do everything: bookkeeping, payroll, sales tax, etc. And I loved being able to help them, right? They came and I was 17 years old and they would still look at me like I knew what I was talking about, right? And I liked that. So I worked at a couple small firms throughout college. And then, of course, in college, what do they tell you? Go work for the big firms. You got to go work for the big four, the big five, right? So I did. I followed suit. I worked with Arthur Andersen for a period of 2 years. And then I moved on to Deloitte & Touche for a period of 10 years, where that experience was unlike anything else, where you're really getting world-class education and training and all of that. The challenge is you're such in a niche, unless you're going to stay in big, big business forever. When I would have friends call and say, "Hey, Deni, I have a tax question." "Yeah, I don't know. I can't help you." Right? Because it was so different. I specialized at that point in my career, worldwide publicly held C corporations. So it's very hard to relate. Tax is a very, very big area. I couldn't relate. I could do my own taxes because they were pretty simple back then, but I just couldn't help. So what happened is I really, after about 12 years, and it was never enough. They always wanted you to work more, and I did. I worked my 20s and my 30s away. And I actually reconnected with a former colleague who was working at Provision at the time, where when we spoke, they told me what Provision had to offer. And really what it was is it was a firm that was able to give that high quality service to entrepreneurs and business owners. That is not normally seen in the market, especially back then, right? You had to be net worth of $10 million for Deloitte to even look at you, right? And so you had the Deloittes of the world, and then you had mom and pop shops who really all they do, and most accountants work this way, is they look in the rearview mirror. When you're doing a tax return, you are looking in the rearview mirror. What did somebody do in 2023? Which is great. You still have some opportunity to save taxes and do things like that, but you can only change, there's very few things you can change from a prior year, right? And what Provision did is they really proactive provision. What we do is we work with clients proactively to plan, strategize, implement, execute, and then a tax return in our mind is just a simple report card. So anyway, back to what brought me here. When we talked about it, it was really that connection to being able to go back to help individuals and families. So I made the jump over in 2012. And really, I do a lot of consulting with clients, a lot of that upfront planning and changing facts and circumstances and just education. We do a lot of education. Most entrepreneurs, they're really, really good at running their businesses. They don't want to be an accountant, but there's certain things they need to understand to make good, educated decisions for their business.
The tax return is just a report card of the result of the strategy. So when you pay, when you do your taxes and you get a tax return, that should really be the proof in the pudding of whether or not your strategy is working or not working. And you're right, a lot of people don't do that front end work, and their taxes are just, whatever ends up being filed in the moment, in the heat of tax season. There's no strategy, there's no planning, when really it should be, yep, we're on track based on the tax return. We made a strategy and the numbers reflect that our strategy is working, or you know what, we might need to adjust some of these things. So anyways, I really like that. We're going to cover a broad spectrum of topics today. You and I kind of planned out how we could make this time the most beneficial and useful. And given that the show is really keyed into entrepreneurs, to business owners, to Main Street, a lot of real estate investors, we're going to talk about a wide spectrum of topics. Selfishly, I'm just going to extract as much information from you as I possibly can in this 45-minute episode. But we're going to dive into topics that are applicable to everybody. I think a lot of people have questions on some of the things that we're going to dive into as we're starting to make, a strategy. We're looking for a person who's going to be our tax professional, and as we're thinking about planning. And so I'm really excited. And as we go through these topics, if something is interesting to me or I have more questions, and we're just going to go down that rabbit hole and ask deeper and deeper, more in-depth questions. But, one of the first things that I think is relevant for us to cover, and you and I had kind of talked about this before we started the episode, is passive versus active income. So can you just start at the high level, give us a breakdown of what is passive versus active income, and how should we be thinking about this as business owners and investors?
And really, clients need to understand this so that when they're making decisions, they understand how it's going to impact your taxes. So generally speaking, we say that there are 3 buckets of income, okay? You have passive, active, and you have investment income, okay? I'm going to spend a little bit of time. Investment income, let's just get it off the table. That's pretty much your investments that result in things that are taxed at capital gains rates, right? You own a stock for longer than a year, you're going to be long-term capital gain. Most people don't deal with that often, more extraordinary type items, okay? More often it's active or passive, and people say, well, what does that mean? So active income is pretty much the work that you're doing every single day. If you're a W-2 employee, that's active income. If you're a business owner where you're participating every day, so it's money that you're working for pretty much on a day-to-day basis. Now that's 10,000 foot view, right? Now, on the flip side, what is passive income? Passive, from a high level definition, is more like mailbox money, right? If you're going to do an investment of some sort where it's actually a trade or business for somebody else, or maybe it's real estate. In general, that is treated as passive income, okay? People say, well, what's really the difference, okay? From a tax rate standpoint, there's no difference between passive and active income. It's going to be taxed at your ordinary income tax rates. The differences is, and why you need to know what bucket different things fall into, is because capital can only offset capital. Passive can only offset passive for the most part, and active can offset active. Okay, and that's why it's important. Now, when I said that passive can only offset passive, there's caveats to that, and we'll probably get into that a little more deeper later on.
To interject here, what you mean is that you can't take losses from a passive income investment and offset your active income earnings. Is that correct?
Absolutely. Yep. So to give you a little more depth, active income and active losses can generally offset, right? Passive can only offset passive. So if you have passive income in an investment and you have passive losses in that same year, you kind of throw them in the passive hopper, figure out what comes out, income or loss, and then you go from there, right?
Okay, yeah.
But oftentimes, if you have passive losses that exceed passive income, that's going to actually be suspended.
So what it sounds like you're saying is that you can carry these losses forward. So if you don't have the ability to offset and use all of those losses in, let's say, this taxable year, there's excess loss that you have remaining, it just doesn't go to zero. You can put those losses towards your earnings next year. You can carry those forward.
Absolutely. You carry them forward indefinitely until one of two things happens. Either that same activity gets disposed of. So let's just say that there's a passive loss of $50,000 associated with that activity. In the year of disposal, what'll happen is it'll then free up and you could utilize that loss against other income. Otherwise, as long as that activity remains, if you have other passive income, you could utilize those losses.
Now, where it gets tricky is, and I know when Trump was in office, he changed the tax code for W-2 employees, I believe, and you'd probably be the expert to pipe in on this. But when we're talking about active income and losses, we're talking about from the perspective of a business owner. It's difficult for W-2 employees to write off business expenses now, isn't it?
Correct. Historically, there was something called a miscellaneous itemized deduction, and it was subject to 2%. So even though it was never a great deduction, if you have business expenses that exceeded 2% of your gross income, you could then deduct them. But currently, those are gone.
Here's a question I have for you, and this is we'll take this personal. So how my structure works is, I have a lot of irons and a lot of fires, right? I have a business that does, private money lending. So I'm lending private money from, myself and friends. I have a W-2 mortgage origination business. It's weird. Mortgages is like my own business, but you have to hang your license in a corporate structure. And to do that, you're only allowed to be paid W-2. I cannot get paid W-2 statutory. I cannot get paid 1099. Must be W-2. And then I have these pass-through entities, which hold all my real estate. Okay, and so the real estate, here's my passive income and passive losses. And I do all of these marketing things, right? I do this podcast. I do a ton of social media work. I host a marketing event. I join these networking groups, all for deal flow. And that deal flow generates leads for my mortgage business, my private lending business, and also my real estate. I generate deals out of my networking events. Now, a lot of the cost is associated with the mortgage business, my software, my computers. So I was doing bookkeeping this year, and I tallied up expenses of $30,000 for the business this year. Okay. I can't write those off at all against my active income. I've tried to write them off on my passive income because, hey, this is how I'm generating deal flow. I literally have deals coming into my funnel from the podcast and the networking. What's happened is I don't know how to utilize these losses in this scenario. High level, what are your thoughts on, I'm in this situation where my W-2 income is a high active earning income. What the heck does a person like me do? And this is not uncommon with a lot of entrepreneurs and business owners. We usually have one thing that's generating a lot of income as we're building all these bridges and, building up these other businesses. What does a person like me do in a situation like that?
So you are the exception, I will tell you, because in general, most people don't have to be paid a W-2 out of, so what they're able to do is they're able to have, an LLC tax as an S corp for their business, and then they're able to write off more of the income. That being said, they probably have a little bit more flexibility than you, right? But you're exactly right. Now, remember, right now, if you allocate it to your business or your W-2, you're getting no benefit at all. If some of it's allocated over here to your rentals, it's going to be a timing difference, perhaps, right? And I don't know all the details of your business. Perhaps you can deduct some of those expenses and maybe they're going to be suspended until a future year. So they may not be benefiting you today, but hopefully they can benefit you in the future. In a lending business, if that's all just interest income, you're once again kind of between a rock and a hard place there. But most people you are probably the exception, because most people would be able to take a good chunk of those expenditures against their ordinary entrepreneurial active business.
It seems like the most logical conclusion for me is to just form a new entity that the private lending and all this stuff is going through. And then I just say all my expenses, the podcast, the marketing is associated with that and offset that difference. I do have a question on lending. Specifically, a lot of people in my industry right now, they're generational legacy real estate owners. They're at a point in their life where they want to sell their property, but they don't want to deal with the capital gains tax. And so the next logical conclusion is, hey, let me carry the note. Let's work out a seller financing thing to kind of offset the capital gains. But then what happens is they're stuck with this active income bill of the note interest. And my question is, what would you do to build a strategy to get rid of the active income off of holding those notes and collecting that interest?
Everyone's facts are a little bit different, right? And so we would need to get into the nitty gritty of every person's facts, but if that is an operational business and you are able to have, active expenses against it, then obviously some of those deductions are going to be allowed because your interest income is your interest income. But, think about a bank, right? They receive a lot of interest income as well, but they have operational expenses that are deductible.
That's
right?
a good
They have
point.
payroll, they have overhead, they have expenses, that type of thing if it's a true business.
Yeah, that's a good point. What about if we take that interest income on our personal return, for example? Can we offset, let's say we buy another property, we go buy another primary residence and we're paying mortgage interest on that primary residence. Can we offset some of the note interest that we're collecting with the mortgage interest that we're paying?
It's on the same property, right?
No, different property. So I have property A and I'm going to sell that, but I'm going to sell it at an interest rate and carry the note and I'm going to earn interest on that every month. Okay. But I'm going to go buy a new primary residence and I'm going to get a mortgage on that. So I'm paying mortgage interest, but I'm earning note interest on the property I sold.
Your mortgage interest is a Schedule A itemized deduction. So it may or may not be beneficial to you anyhow because of the fact that, there is a floor in which itemized deductions, you're able to utilize them anyway. So let's skip away for just a second. So generally when you're dealing with personal mortgage, itemized deduction versus standard deduction, remember the way that the tax works, your net income from business plus your W-2 plus capital gains, losses, whatever, totals your gross income. And then you have the next step is either an itemized deduction or standard deduction. So every person or couple is entitled to one of those two base deductions. So let's say that you rent your house and you really live in a state that pays no state tax. So you have no mortgage interest, you have no state tax, you don't have big medical, you don't itemize. So those people get a standard deduction as well. And for 2023, I believe it's $27,000 and some change, almost $28,000. And then of course, if you're single, it's like half of that. And then you only get a deduction for itemized deductions for amounts over that, right? And so you either have to have mortgage interest on your personal residence, plus you can only do $10,000 worth of state taxes, which that's state income taxes, vehicle registration, things like that. $10,000 is a cap on state taxes. So medical expenses, you're only allowed to take a deduction. Medical expenses over 7.5% of your gross income. So let's just say you make $100,000, you get zero deduction for medical expenses unless you're over 7.5% of that. So most people get a big fat goose egg on that, which is good because that means you're probably not that sick. So that's one good thing. State taxes is another one, cap of $10,000 for a married couple. And then mortgage interest is whatever that is. Now, if that amount is and charitable donations, right? If all of those exceed $27,700, then you're able to take that amount as itemized deduction.
There's a limit on charitable donation that you can offset your tax liability with?
There is, but it's like 60% of gross income.
Oh, okay.
There's different limits, 50, 60%. But the total of those mortgage interest, charitable deductions, state taxes capped at 10 grand. The only cap there is 10 grand on state taxes. Mortgage interest is capped. So let's say that you have a new mortgage that was generated in the past, let's say 7-8 years. If your mortgage is over $750,000, you're limited to mortgage interest on $750,000. There's some grandfathered of over $1 million, but so that can be limited as well. So remember, that type of interest is a personal deduction, and any interest you receive from doing lending is income on that side. So they don't offset in the same place.
Given what you're saying about a cap on mortgage interest, it almost makes me wonder, why would anybody buy a home over $750,000 or whatever you said the limit was in their personal name and not in like the name of a business and then associate expenses with it?
Generally, even if you, so let's say it's your primary residence, but you operate, let's say that you have a business and you don't have another office. So you operate it out of a home office. What you're eligible to do is if it is your primary place of business, you're able then to take or you could be eligible, right? Everyone's taxes are different, but you could be eligible to take home office deduction, which what that is you kind of slice and dice your primary residence. You do it either by square footage or you do it by the room method, some method to determine how much of your home is used for business, okay? Then you get utilities associated with it and a whole bunch of things, but you're still not going to be able to deduct your entire home. Unless, let me give you a different example. I do have a client that purchased a residential property and they don't live there. All they do is they turn it into their office and they have workers come in and work there. So that is actually their office.
Could your business purchase a property that you rent, you pay rent to your company to rent out to try to capitalize on?
You can, but your rent needs to be reasonable.
Right.
Right. And some of that home is still going to be personal usage, right? But what you also have to remember is this. If you are paying rent, you are collecting income on the personal side, right? If it's a personal residence, you're collecting rent from your business on one side, so that's income. And then the offset of rent is on the other side. So yes, there's other things you'll be able to deduct, but really those two net to zero. One other thing I wanted to point out real quick is that you had mentioned, should my company buy the property? The one thing you want to make sure of, and this is important, and a lot of people, with primaries, it's different. It depends on what state you live in, and you would want to talk to an asset protection attorney. But in most cases, you get the homestead exemption for your home, right? And so the attorney will generally tell you whether or not it makes sense to put that in an entity or not. But also remember, most people's businesses, if they're profitable to the tune of $40,000 to $50,000, it's likely they're probably going to be in an S corp, maybe in a C corp, but C corps aren't used all that often, not much anymore for small businesses. But if it's in an S corp, generally you don't want appreciating assets, which a property would be, right, in an S corp, in a corporation at all. Okay, so let me kind of elaborate with one more. Let me give you an example, like a dentist. It's a perfect example. So a dentist, he might buy a commercial building to operate his practice out of, but it's very likely he's going to create a different entity to own, like a LLC perhaps, to own that real estate. And then his dental practice is going to be in an LLC taxed as an S corp. Those are in two totally separate entities. And then his business pays rent to the property LLC. Now, people say, well, gosh, why do you do that? A couple reasons. For one, the asset protection attorneys are going to talk to you about this when you're talking about how to structure. And we always want to bring them on board because CPAs cannot advise you on legal things, but we like to work in conjunction with them. But for the most part, you generally, for liability reasons, you don't really want your operating business that's going to be, especially medical practice, malpractice, and different things like that, in the same entity, legal entity as real estate, right? That's kind of risky and have all that equity perhaps at risk. Secondly, if you ever wanted to refinance and you had a property in the S corp, if there's any appreciation at all in that property, it could trigger gain just by refinancing. And so it really kind of takes some of your cards away as a property owner. Why would you do that? Because you might have to pay gain and you're just trying to refinance. You want to make sure you're doing things that you're setting up correctly, accounting for things that could happen in the future.
In the beginning of this conversation, you were talking about, and I got us way down a rabbit hole, which I told you I was going to do. But in the beginning of the conversation, we were talking about passive versus active income. And you said there are some exceptions on when, passive could offset active. And I wanted to jump back to that placeholder and kind of dig into that a little bit, because this is also a big topic in our real estate space. It's widely misunderstood. People are often scared of it, but yeah, I was hoping we could dig into this.
Now, here's the thing, and there's a couple different directions we could go with this. So in general, I said real estate is passive. Okay. Now, we know that there are people out there that do real estate for a living. There's also people out there that have a rental property or two, and then they have a W-2 job or businesses or whatever. So in general, real estate is considered passive. The exceptions to that, these are the big ones first, and then we'll dive into another one. The first one is, in order to be qualified as a quote-unquote real estate professional, first of all, a misnomer is people think you have to be a real estate agent. You don't. You don't at all. But you do have to meet two big hurdles to even consider it. First of all, is you have to spend more than 750 hours a year doing real estate related activities.
What would you call real estate related activity?
It could be rehabbing, it could be purchasing, it could be flipping, it could be, or not flipping, rehabbing, designing, developing, could be selling. Some of your hours could come from if you're a real estate broker and you actually are spending time doing things like that. Anything under real estate and anything having to do with real estate.
What about education?
Count. Education is more of a gray line, and you would have to look to see exactly what you're doing in that education space.
Would you consider this real estate related activity?
It very well could be. And a lot of times, because you cover a whole lot of other things, some of your time might not count. Okay.
Right,
now,
right.
Let's say that people say, yeah, I'm in real estate. I have a full-time job, but I do due diligence on all these syndication deals that I do. Well, that's your time spent as an investor, right? Because you're kind of turning everything over. You're doing due diligence. You're going to do that whether you're an investor or a real estate professional, but still those hours that you're spending doing those types of things, working day to day, for the most part, if you're working in real estate day to day, those hours will very likely count. But there are some things that are excluded and things like that, but we'll kind of keep it at that for now. So the first hurdle is 750 hours spent doing real estate related activities. Second hurdle is you have to spend more than 50% of your time doing real estate related activities. So example, you might spend 1,000 hours doing real estate activities, rehabbing, whatever, constructing, whatever. Let's say you spend 1,000 hours, but let's say that you spend 1,200 hours doing a W-2 job. Let's say you're a teacher or whatever. You meet hurdle 1, but you don't meet hurdle 2. Okay. I also have many clients that say, Deni, I'm at 751 hours this year. To me, that's scary because of the fact that real estate professional is such a really good deduction that it does get audited more frequently. And I tell people, don't be afraid of it, but you need to document your hours. And I always say, if I'm an IRS agent and I'm looking at someone's real estate log and you met 751, how much of those are stretch hours, right? So most people, I say 900 is better, and it's hard to get more and more hours. Okay. But those are the two general hurdles. You then need to look at each underlying activity to see if you meet what's called the material participation tests. And in general, you might meet the two hurdles of real estate professional, but you might not meet material participation on your activities. And material participation is a series of tests that you only need to meet one per activity. And the rule says, by default, you need to meet one material participation test, and then that activity qualifies. And so I always tell people, I give them this little Excel chart. You go down the list. Activity 1, do I meet test 1? If you say yes, you move on. If no, go to number 2, and you go down the list. Now, there is an election that says if you have rental real estate, you can group all of your rental real estate activities together to meet material participation. What I mean by that, let's say you have 10 rental properties, long-term rental properties, and you might spend quite a bit of time at each one of them. You might spend a lot of time, but maybe your handyman spends more time or something. But when you group all 10 of them together, you could meet the 250-hour test or 500-hour test or whatever. And we won't get into those details because they're very detailed. You can group them together to meet material participation. Now, you always want to be sure that you understand the cons that could come with that election as well. So once you group those as one group, you can't unwind that election. So what that means is, generally speaking, and we're getting a little detailed here, but I think it's important. Let's say that you originally had passive losses, and then in 2023, you become a real estate professional. And now all of a sudden, those passive losses are still passive losses. They're going to continue to stay there. In 2023, you group all 10 rental properties as one activity. You're now a real estate professional. So let's say that $50,000 worth of losses now is able to offset ordinary income, because that income is now, or losses are now active because you've qualified for real estate professional. You met real estate professional. You've met material participation. So those losses are now active. But remember, you still have these passive losses from prior years that are suspended. So let's say in 2024, you sell one property. Normally, in the year of sale, that passive loss from property one would free up and be able to offset that gain, but not in the situation where you've now grouped them together. In order for those passive losses to free up, you have to sell the last one that sells frees up all the losses, right? So even though real estate professional sounds very attractive, there are definitely some cons to it, and it may not be there. If you're going to sell 2 properties next year, it might not make sense to make the real estate professional election because you've got all these losses that make sense to free up in the next year. It's all facts and circumstances.
Now, in this case, where my mind jumps, and you can correct me if I'm wrong here in how I'm thinking about this, but you're like, okay, you group all these properties together. For example, if you were to sell now, you're susceptible to the tax at this point because you have these losses that can no longer carry forward. My brain just says, okay, fine. I'm just going to go buy a new property and do a depreciation on it. I'll just do a depreciation study on it and take 100% depreciation and offset the gain. Is that what's your thought process on that?
Yeah. So remember, the way that it works is that if you have a gain on a property, remember that those prior passive losses are still available to offset gain and income, right? They're still available, but that loss on that one property doesn't automatically free up. So really it's facts and circumstances based on your case. So in some cases, you might say, yeah, let's just group them together. And when I sell this property, maybe I just do a 1031 exchange, or maybe I buy a new property and do a cost segregation study on it. It really just depends on the numbers, the facts, and how much passive losses you have and how much that real estate professional designation is going to benefit you. Because I have a client that's like, Deni, I want to take it. Well, I'm like, well, your tax rate's so low. Even if you don't take it, you're really not paying any tax. So why take the risk? And this year, have those passive losses available for future. So we just put it in the back pocket and he'll continue to qualify, but we're not claiming it because it's not beneficial. He's never claimed it before. We're not claiming it now. Right. And it's just because his facts didn't really line up to be able to take it. And we're not afraid of real estate professional by any stretch of the imagination. The key is we tell clients you need to contemporaneously document your hours, because if you do get selected for audit, because it is the big deduction, as I mentioned, you're probably more likely to get audited than if you just treat them as passive. So you're not afraid of it. You just have to be prepared.
Correct me if I'm wrong, but on my end, doing like the financing, the money of real estate, I'm doing all I do is real estate. That's it, all day long. But I don't think that qualifies as real estate professional. Is that correct?
Generally, in mortgages, those hours don't generally qualify because that's actually financing.
Right.
Even though it's financing, real estate is financing. If instead you were a broker, you're selling real estate, but you might as well be financing. You could finance anything, you could. And so, yeah, those hours don't necessarily count towards real estate professional.
So for me to get the real estate professional status, I would need to then probably lump my real estate portfolio together and look at the collective hours in order to get it. But then, I'm a buy and hold investor, but so I'm not at risk of if I sell one property, but you never know. I might need to sell one. I might need to liquidate one. And so, yeah, it opens up a whole other can of worms. And so it sounds like, when you're looking at this chessboard, is there another lever that we can pull first before executing this one? Because we may be able to offset the gains anyways, just implementing a different strategy before we pull this trigger of the real estate professional.
I have a lot of clients that are actually full W-2, very large, like doctors, right? $2 million W-2s, right? So their strategy is they're never going to qualify for real estate professional and maybe their spouse isn't interested. So their strategy might be, I'm taking a lot more of my disposable income, investing in real estate. It's just going to be passive to me. So what we then need to do is, it's a timing issue, right? And so, I have clients that have invested in real estate, let's just say for 10 years. So what they'll do is they'll invest in a couple syndications or they'll go buy their own properties, and then each year over time, the first number of years, loss, and they get a big old loss bucket, right? And then over time, as things sell, they might have a $500,000 gain. Well, guess what? Okay, they're putting more money into real estate, getting more cost segs, but then they're eating up their passive loss bucket And so they continue to reinvest every year. So what happens is, in the first handful of years, they get no benefit. But as that wheel continues to turn, there's always property selling. You're getting gains. You're getting cash flow from that. You're getting big cash flow returns from that. And it's very likely you may never pay tax, right? So they've just shifted their strategy to more passive. So then what we need to look for them is we're looking for more income streams that are going to offset passive income, perhaps, right? So those are called PIGs, passive income generators. So if you have tons of passive losses, then we want to look to see what is going to produce you some passive income, other items. And so we can time them right and things like that. And you can't always time it because in most cases, you're a passive investor in these deals. You can't pull the lever and say, sell this now or sell this later. But in some cases, if you do own some of your own real estate, you're like, heck, I have this lever I can pull here and I can trigger this in this same year or whatever, And so they just come up with a little bit different strategy. So real estate professional is not for everybody, and it's not the only strategy out there.
We had so much more that I wanted to go over, but since we're on this topic and I know we're like already running out, I told you that this was going to go so fast. We're going to have no time. Since we're on this topic of real estate professional, I did want to kind of divert slightly and talk about short-term rentals. That is something, it just popped in my brain. I could either lump all these properties together, but also I have an interest in a few short-term rentals. One is 100% interest, and then one is like a 14% partnership. How could I utilize a short-term rental to offset my tax liability?
So when I had said that real estate by nature is passive, but there's some exceptions, this is another exception. So in general, the way that we think about short-term rentals is most of them are 7 days or less. That's like a hotel, right? So if that is the situation, on average, your stay is 7 days or less, the IRS doesn't treat that as rental. So any hours that you spend on short-term rentals doesn't get included in your real estate professional hours, because most short-term rentals are, as long as you meet material participation, you don't even have to look at real estate professional hours. You just have to meet material participation, and then those flipping activities would be active to you. So for example, I have a client that has a number of short-term rentals, and because it's one house here, they grouped them together and they have one activity that's short-term rental activity, right? And it includes multiple properties. And so what they do is they come in, they buy them, they rehab them. In that first year, you're furnishing, you're rehabbing, you have a lot of money spent out there. So you're able to deduct a lot of that. Now remember, bonus depreciation currently for 2024 is only at 60%. We don't know. There's a bill that was introduced in December that hasn't made its way to the Senate, and so it's kind of stalled. We don't know what's going to happen, but a lot of people in real estate think at some point they'll bring it back to 100%. For now, it's 60, okay? So, but still, in that first year, you're able to deduct a lot of those costs. Your bedding, your towels, your linens, a lot of your decorations, things like that. Those are small purchases. You get to deduct a lot of those things in year one, right? So in year one, most short-term rentals, I shouldn't say most, but a lot of them end up in losses, right? Well, that's a great way right there to be able to offset your W-2 income as long as you meet material participation. You meet one of those tests, because that flipping is a very, very lower threshold. It's the same threshold. Material participation, in order to treat a business as passive or active, you have to meet one of the same tests. It's the same, because you might have a business that you're invested in where you might be a 20% owner, but maybe you're just the money guy or whatever. So that business itself may be passive to you, but it is a true active business to somebody else. Flipping and short-term rental are the same. And I kind of went off on flipping, but it's the same. Short-term rental has a lower threshold, but then flipping, on another hand, that's a trader business, right? So flipping, it would be if you have losses, which if you're flipping and you have losses, you probably shouldn't be in the business, because who wants to go in to flip? Flipping will be ordinary income, right? But the way that I see it is with the short-term rentals, generally in the first year, many people have those losses. And then maybe in the next year, they do another one or whatever. There's a lot of costs that go into short-term rentals.
So it's not necessarily that you're qualifying as real estate professional. It's just you're able to utilize those losses up front. And as you were talking about this, I'm like, okay, I have one property that potentially could qualify, although we do a lot of midterm, which is like 30 days or more. So then in that case, it probably wouldn't qualify, right?
Right. And what it comes down to is there's a lot of fine print in there. And so for the most part, 7 days or less is always short-term rental. And then over 30 days is generally considered to be more long-term.
Right.
So what you have to look at is maybe you need to work on getting your average under the threshold so that you can qualify it in a year as short-term. And to be honest, there are some cases where in the first year, gosh, I want it to be short-term because I have losses. But in future years, short-term rentals are very profitable. You may want to then stretch out your term to 30 days or more as an average. In future years, it's going to be passive or could be passive.
Right.
And then losses from long-term rentals are offsetting, the income from the mid-term rentals. That's a strategy as well. Right. So one strategy may not work for you, but it might work for somebody else.
And this is a very delicate dance because this other property that I'm talking about with the 14% interest, it's a big commercial property. It's like a 20,000 square foot building. We have to get big bank debt on it. And so as you're talking, I'm like, we wouldn't want to do that strategy because when our debt stack readjusts in a couple of years, we have to show profitability. So if we're writing all of our stuff off, the bank's not going to give us a loan based off of performance of the business asset. So, and all of this, I think just beautifully circles, highlights, and puts a point on if you're a business owner or you're an entrepreneur or you're an investor, you cannot possibly make these decisions by yourself. You need advice. You need strategy. You need planning. You need a person who's been in the industry since they were in their early 20s or high school, helping you make a plan to navigate these murky waters. And you know what? I'm not uneducated. I feel like I'm pretty well versed. I've been in the game, showing up day after day after day. And even still, it's like you can't know everything. You can't expect to know everything. You need to surround yourself with people who can supplement your weaknesses and help make a strategy and plan because, whether people are aware of it or not, our biggest expense every single day, our biggest expense hands down is taxes. If you just took the amount that you spend on taxes and instead of just automatically getting it deducted and you pay for it automatically, but it goes into a bank account that you look at every time you log in to see your savings account. And then at tax season, you watch it vaporize away. More people would start prioritizing planning and strategy.
I can't emphasize that enough because oftentimes, we get questions from clients who are like, well, what do I do? Well, I don't know. And like I said, if I have 5 clients, there might be 5 different scenarios where it makes sense to have 5 different decisions, right? And I mean, there's so many more rules we didn't even touch on. It gets deeper and deeper, and it's very, very fact specific. And so that's what we tell clients is one solution does not work for everybody. The most important thing is education. And like you said, you're very well versed in many things, but there's still things you don't know. Right. And so you need to sit down and do the proactive planning so that you can put in place, your strategy for the next couple of years. Well, guess what? There's going to be a wrinkle in it and we may have to come back and readjust it. That's okay. But at least you kind of know, hey, when I do this, this is what I need to do. When this happens, I need to do this. I pull this lever, I do this. Oh, facts change. Let's call back. Let's revisit and kind of regroup and maybe go a new direction. But to me, that is what makes it so fun is you're not always giving the same answer, right? And it is a chessboard, like you said.
And it's your benefit. A lot of people, and I'll end with this. And I know we're out of time here. I'm going to end with this. A lot of people are like, oh, you should pay more taxes. You have an obligation to pay more taxes. And, I would say 2 things to that. Number 1 is I'll ruffle feathers right off the bat. Do you honestly trust the government to make good decisions with your money? Just look at their track record of what they spend their money on. For me, the answer is not no, but hell no. No, I do not want my money going overseas to fund crazy proxy wars or who knows what gender study of toads on some random river. I don't want the government to have more of my money, number 1. Number 2, the tax code was written to incentivize risk from business owners. You're not stealing any money. business owners create a structure and a scaffolding that give other people opportunity, that stimulates the economy, that provides jobs, that puts money into the market, that has a symbiotic and altruistic effect of the transfer of goods and housing and purchasing and selling and stimulation. And if you remove these incentives in the tax code for business owners to move forward and take these risks, nobody's going to create anything. There's going to be no structure. There's going to be no scaffolding. If there's no risk, there's no incentive for business owners to grow and build and provide opportunity for other people to come work for you. We're going to live in a world that I don't think that we truly grasp how terrible it could be. This is not like stealing from the government. You're utilizing incentives in the tax code that the government made specifically for this purpose. This was an outstanding episode. We definitely ran out of time. We talked about one of the topic really that we were going to talk about. You and I talked about 5 topics that we wanted to get into. You are obviously a wealth of knowledge, a wealth of information. How can people get in touch with you? If people want to come find you, sit with you, maybe see if you guys are a good fit, potentially talk about some strategy and planning, what's the next steps? How do people get in touch with you? How do they find you? What should they do next?
Reach out to us. We actually just go to our website, provisionwealth.com. And I believe we also have a QR code right there that'll that I believe Tim has and can get out to you. But yeah, call us. Let's see if we're a good fit. We're not always a good fit for everybody, but we would definitely like to talk to you. And we're honest. We'll say whether or not we think we could provide you value, we may not be able to. And we'll be honest with you on that because we want to make sure that, as many clients end up in the right hands as possible. And, we're a good fit for many, many people. Entrepreneurs, business owners, real estate is what we really specialize in. We may not be able to provide you the value, and we'll be as honest as we possibly can with you. And so when you reach out to us, we actually have one person on our team that talks to all potential clients and talks about your situation and what you have going on. And they'll be able to actually guide you and say, we think we'll be a good fit. Here's what I think you need. And then, of course, you go through the process to become a client. And then, there's 6 of us partners here. And so, if there's someone specific you want to work with, don't hesitate to ask. But otherwise, you'll be in good hands with any of our partners.
Well, Deni, thank you so much. I learned a ton from this episode. I know the audience did too. I'm going to put all of your information in the show notes. So anybody listening to the show, just scroll down. You could find all her information is on there. We'll try and include her social media and her LinkedIn as well, which is a great place to connect with her. Thank you guys so much for listening. Don't forget, please guys, go subscribe to the show and give us a review. The reviews are the tax. You want to talk about paying taxes? This show is not free. The reviews are the tax for listening to this show. This show is a free service for you, the business owner, the entrepreneur, to help you grow and get to the next level, to remain autonomous and free, guys. And we just ask that you help keep this going, pay it forward, help other people find us. And the best way you can do that is subscribe, tell your friends to come listen, and give us a review. Thank you for listening. We will see you all next week. Catch you on the flip side.